Welcome back to the ETF Investor. If you're new here, make sure to like, subscribe, and tap that notification bell so you never miss out on smart, easy-to-understand ETF breakdowns. Today, we're diving into an important core equity ETF that many investors overlook, the SPDR Portfolio S&P 500 ETF, ticker symbol SPYM. If you're building a low-cost, diversified U.S. equity portfolio, this is one you'll definitely want to understand. SPYM seeks to track the total return performance of the S&P 500 index before fees and expenses. If you're familiar with the SPDR Portfolio ETF lineup, you already know it's designed to offer broad, cost-efficient exposure to major asset classes. SPYM fits right into that theme as a straightforward, low-expense way to capture the U.S. large-cap market. Now, let's break down how the index behind SPYM is constructed. This ETF tracks a market cap-weighted index of 500 large and mid-cap U.S. companies. But here's something investors often miss. The S&P 500 is not simply the 500 largest U.S. stocks. It's actually a curated list selected by the S&P Index Committee. That means the committee chooses at least 500 securities that they believe best represent the U.S. large-cap space. They consider sector balance, minimum size requirements, and trading liquidity. So yes, occasionally some big-name companies may be excluded or added later than expected, depending on how the committee evaluates them. The index is rebalanced quarterly, which helps maintain its sector structure and keeps the fund aligned with the broader market landscape. For investors seeking long-term exposure to major U.S. companies across technology, healthcare, financials, energy, and more, SPYM delivers that familiar blend we associate with large-cap U.S. equities. SPYM has also gone through a few changes over the years. Before November 16, 2017, the fund actually tracked the Russell 1000 index and traded under the ticker ONEK. Then, before January 24, 2020, it tracked the SSGA Large Cap Index. And before October 31, 2025, the ETF traded under the ticker SPLG and didn't carry the State Street brand reference in its name. Today, under the SPYM ticker, it's part of the streamlined SPDR Portfolio family, benefiting from the reputation and scale of State Street Global Advisors. So why do investors consider SPYM? For many, it comes down to three key factors: broad diversification, ultra-low cost, and familiarity. You're getting exposure to companies that dominate the U.S. economy. Names in technology, consumer discretionary, financial services, industrials, and more, all wrapped in a passive index fund that aims to mirror the performance of the S&P 500. As always, keep in mind that while SPYM is designed for long-term core exposure, market cap-weighted indexes tend to be top-heavy. A handful of mega-cap companies can significantly influence performance. For some investors, that's a benefit. For others, it's something to be aware of when building a well-balanced portfolio. If you're thinking about adding SPYM to your own portfolio, make sure it fits your risk tolerance, your time horizon, and your overall asset allocation strategy. And that wraps up our SPYM analysis and insights. If you found this breakdown helpful, hit like, subscribe, and drop a comment below. Let me know what ETF you want me to cover next. Your suggestions help shape future videos. Thanks for watching, and I'll see you in the next one.